a homeowner has its pros and cons. I've been both a homeowner and a renter, and I can tell you from personal experience, it can definitely hurt or help your finances depending on your location, mortgage debt, property taxes, insurability, and overall financial goals. I think the joys include having a place to call your own and the chance to build equity. According to a 2024 report, the average homeowner has just under $300,000 in home equity, with $193,000 available to be tapped. That's the highest amount on record. So if you're a homeowner who's been watching your equity grow, you might be wondering if you should dip into it with a home equity line of credit, or HELOC. This podcast will review what a HELOC is, who qualifies for one, how you can spend it, and the pros and cons to consider. Plus, I answer a question from Jason about my opinion of velocity banking and how it relates to getting a HELOC. Welcome back, everyone. Thanks for joining me on episode 872. I'm Laura Adams, an award-winning author, finance spokesperson, money speaker, founder of The Money Stack, which is a Substack newsletter, and host of The Money Girl podcast with over 43 million downloads. If you're getting value from the free content that we love creating, please subscribe, and I'd love for you to consider submitting a 5-star rating or review on your podcast app. If you've got a question about money for the show that you'd like me to cover, you can leave it on our voicemail. That number is 302-364-0308. You can also send me an email and sign up for the free Money Stack newsletter when you visit lauradadams.com. So let's talk about what exactly is a HELOC. I think most people are familiar with a home mortgage, which is an installment loan with a fixed maturity or ending date, like 15 or 30 years. Well, just like a mortgage, a HELOC is debt secured by your home. But a HELOC is fundamentally different from a mortgage because it's actually not a loan, but a revolving line of credit. So that means you can access it anytime you like up to your available credit limit, kind of like a credit card. Your lender gives you a line of credit for an amount which depends on the available equity in your home. Another similarity between a HELOC and a credit card is that they typically have variable interest rates. So that means the rate gets tied to a financial index, such as the prime rate, which can go up or down. So that means your minimum payments can go up or down. In some cases, you may be required to make an initial draw on a HELOC, such as taking $5,000 or $10,000, depending on the total credit line amount, just to ensure that the lender earns some amount of interest on you. And you can spend HELOC funds, pay it back, borrow more, or set it aside for emergencies. It's pretty flexible. Once you take money from a HELOC, it gets deposited into a companion checking account that you access, like any other account with a debit card, paper checks, or an online account. And as I mentioned, you can spend it on anything. It could be education, home improvements, a down payment on another home, or even paying down your mortgage. And I'll talk more about that in a moment. So what's required to get a HELOC? If you're considering tapping your home equity, you want to consider 5 HELOC requirements. Number 1 is you got to have enough home equity. Most HELOC lenders require you to have at least 20% equity in your home to qualify. So equity gets measured by your loan-to-value ratio. This is going to compare the total debt on your home to your home's fair market value, as determined by a certified home appraiser. For example, let's say your home is worth $400,000. If your mortgage balance is $340,000 and you want to borrow $20,000 using a new HELOC, then your loan-to-value, including the new HELOC, would be $360,000 divided by $400,000, which comes out to 90%. Having 90% debt on your home leaves you with just 10% equity, which is typically too low to satisfy a HELOC lender. As I mentioned, you typically need at least 20%. So not every homeowner has enough equity to get a HELOC. However, lenders have different requirements and evaluate you based on other factors that we're going to review. So the second requirement for a HELOC is that you must have an acceptable debt-to-income or DTI ratio. Your DTI includes all your debt, like credit cards, auto loans, student loans, and mortgages. For example, let's say your total debt payments are $2,500 a month and your gross monthly income is $5,000. Well, in that case, your DTI is 50%. So it's $2,500 divided by 5,000 is 0.5 or 50%. Most lenders have a DTI cutoff of 40 to 49%. So having a DTI 50 might be too high. And of course, the lower your DTI, the better. Your DTI is a strong indicator of how easy or difficult it may be for you to manage an additional debt. So if your DTI exceeds an acceptable level, you'll need to pay down your debt, increase your income, or do both to get a HELOC. The third requirement is that you must have ample income. Just like with all creditors, the amount you earn is a factor in getting approved for a HELOC. You have to show that you earn enough to cover your current debts plus the additional line of credit you want. You'll typically need to show at least 2 years of banking records or tax returns to prove that your income is high enough. Requirement number 4 is that you must have a consistent income. HELOC lenders also consider if you can repay a debt. They review how consistent your income has been in the past few years. Plus, they look at assets you own, like your savings and investments that you could liquidate to pay debts if needed. And the fifth requirement is your credit score, another important way that all creditors, including HELOC lenders, evaluate your financial responsibility and willingness to repay debt is your credit score. While the minimum score varies, the higher the better for getting approved at the lowest possible interest rate. If your credit is not good, you may still be eligible for a HELOC if you have plenty of income and home equity. All the factors I just covered get taken into account. So being slightly deficient in one financial area may be okay if you're strong in another. So what happens if you do get a HELOC? How do you manage it? Well, after you tap your home's equity with a HELOC, you must repay a minimum amount each month. There are typically 2 phases for repayment. You have a draw period and then the repayment period. The draw period is when you can borrow from a HELOC up to your credit line amount with interest-only payments. For instance, if you have a HELOC with a 20-year term and a 10-year draw, you must pay minimum interest payments for the first 10 years. After the draw period ends, you can no longer borrow against your HELOC, and the repayment period begins. Your payment then gets amortized, which means it's made up of principal and interest over the remaining 10 years. That ensures your balance gets paid off by the end of the term. However, HELOC terms can vary depending on the lender. Some may have a balloon payment or a larger than usual payment at the end of the term. Some HELOCs may not have a repayment period, but require full payment at the end of the draw period. One significant benefit of a HELOC is that it may come with a tax deduction, depending on how you spend it. For example, if you use a HELOC to buy, build, or remodel your home, you can deduct interest on up to $750,000 or $375,000 if you're married and file taxes separately. That debt limit includes your mortgage, the HELOC, and any other home-related debt you have. For instance, let's say you have a $500,000 mortgage and get a $150,000 HELOC to remodel your home. You could deduct interest on up to $650,000 or all your home-related debt. But if you have a $200,000 mortgage and use $25,000 from a HELOC to pay for college expenses, none of the interest paid on the HELOC would be tax deductible. Again, you can spend a HELOC on anything you like, but only the portion used for home-related expenses is eligible for an interest tax deduction. So if you're considering a HELOC, understand that you may not be eligible to deduct your interest expense, depending on how you use the money and whether you itemize deductions on your tax return. Now, let's talk about if you can use a HELOC to pay off a mortgage faster. With the rising popularity of low-interest HELOCs, many homeowners use them to pay off other debt. Whether you should use a HELOC to pay off your primary mortgage faster is a hotly debated topic and is often part of a strategy called velocity banking. I received an email from Jason G., who said, "Hello, Laura. I see so much about velocity banking. What are the hidden truths about this? It seems like a high-risk, high-reward trend." Thanks so much for your question, Jason. Yes, velocity banking comes with a lot of potential risks. Without going too deep into the math on it, the general concept in velocity banking is using debt with simple interest, such as a HELOC, to pay off amortizing debt, such as a mortgage. Plus, if your HELOC has a lower interest rate than your mortgage, you could save money by spending a HELOC to pay down your primary mortgage faster. The problem is that drawing down your HELOC can be risky because it's typically a variable rate product, which means you could have substantially higher interest rates and monthly payments in the future. Also, you must have a lot of home equity to get a HELOC big enough to make a dent in your primary mortgage. I'd say unless you save at least 10% of your gross income for retirement, have an ample emergency fund, and have zero debt besides your mortgage, paying down a mortgage early using a HELOC or even using your savings is not wise. And I've podcasted about this topic before. You can go back in the archive and check out episodes on paying off a mortgage early. But if your finances are in great shape and you've got plenty of retirement savings and no debt, you may be in a position to pay off your mortgage ahead of schedule. But instead of using a HELOC to do it, I'd recommend just paying extra toward the mortgage principal each month. And again, I've podcasted about this, so there's a lot more about it in the archive. So let's review the pros and cons of getting a HELOC. In addition to the potential tax deduction I covered, a HELOC has other benefits. Using your home equity for renovations could increase the market value of your home, helping you grow your net worth. I'd say the primary advantages of a HELOC are having the flexibility to tap a line of credit whenever you need it, only paying interest on the amounts you use, paying a relatively low interest rate, and spending that money on anything you like. The biggest downside of a HELOC is that borrowing against your home puts you at risk. Since your property is collateral for a HELOC, the lender can force a home sale to satisfy your debt if you can't repay it. Also, if you take a HELOC and the value of your home drops, you may have to come up with cash to repay it. If you qualify for a HELOC, the primary cons are paying interest on amounts borrowed, paying lender fees to originate the line of credit, having a variable interest rate that can increase significantly depending on your lender and the laws in your state. And of course, missing payments can hurt your credit scores or cause your HELOC interest rate to increase. Applying for a HELOC can be a sensible and convenient way to cash out part of your home's equity. But remember that your net worth can decrease if you spend it on something that decreases in value or has no value over the long term, like consumer credit card debt or a vehicle. While tapping your home equity can be convenient, carefully consider whether decreasing your equity and paying interest on a HELOC is worth it. It likely isn't worth it if you would spend the money on something that doesn't bring you closer to achieving your financial goals. Before we go, a quick reminder to subscribe to The Money Stack, my weekly Substack newsletter, when you visit lauradadams.com. It's filled with money tips, tools, news, challenges, and things I enjoy. You can subscribe for free or support the show and become a paid member with access to live educational events. That's all for now. I'll talk to you soon. Until then, here's to living a richer life. Money Girl is a quick and dirty tips podcast, and I want to thank our amazing team. Steve Rickyberg audio engineers the show. Brandon Gachus is our director of podcast. Holly Hutchins is our digital operations specialist. Morgan Christensen is our advertising operations specialist. Davina Tomlin is our marketing and publicity associate. And Nathaniel Hoops is our marketing contractor.